The market is being set up right now, in my view, if these continue, these dynamics here, bond yield suppression to the highest order, a weaker dollar on a relative strength basis, and crude oil getting propped up, we're going to get a Santa Claus rally that is going to spin people's heads around like the freaking Exorcist. Now, how does this generally set up?
Gregory Mannarino is an American stock trader, investor, financial commentator, and YouTube personality. He is the founder and owner of Trader's Choice, a financial education and trading services company. He is also a regular contributor to the financial news website Real Money Pro. Mannarino is a well-known figure in the financial community, and his opinions on the markets are widely followed. He is a strong advocate of technical analysis and has developed his own unique system for trading the markets. Wall Street investors, traders, and analysts have long been fascinated with the stock market. From the highs and lows of the market to the trends and predictions that come with it, many are eager to find out what will happen next. One of the most well-known figures in this space is Gregory Mannarino, an independent analyst and trader with over 20 years of experience. He recently made headlines when he predicted a Santa Claus rally for the stock market. Mannarino believes that the stock market will continue to climb higher in the weeks and months to come and that investors should take this opportunity to prepare for the rally. His predictions are based on his technical analysis of the market and his understanding of the global economic landscape. With his track record and experience, it's worth taking a closer look at his predictions and understanding how investors can prepare for the Santa Claus rally. Welcome to Savvy Economists. In this video, we will explore Gregory Mannarino's view of point about a possible Santa Claus rally. Please watch, like, and share this video. Also, drop your comments and thoughts below. Remember to like and subscribe to the channel for more related content similar to this.
The Santa Claus rally won't really get going until maybe 2 weeks. All right, so for now, the market is going to gauge by looking at the 10-year yield, by looking at the relative strength of the dollar, by looking at crude oil, how this is going to play out. And institutions, traders, investors are going to position themselves for a year-end rally. Again, unless something acts against this, and you and I already know what the drivers are. All right, we got this covered. There's going to be a lot of money to be made here. And you know what I'm talking about? Just fantastic. So 300's the line in the sand. We're at like 228 right now. And like I said, if this continues, if we see the 10-year yield continue to drop and the relative strength of the dollar drop, you knew this from months ago, how I said if these dynamics would play out like this, we would see the stock market put on gains. This market has put on substantial gains as of late. And I still sincerely believe, just like I started off with here, a year-end rally looks like it's in the cards unless something acts against it. Who knows? Some black swan event, some issue with whoever they want to blame it on, okay? And that's just the way it's going to go. I think it's pretty evident here.
Gregory Mannarino is predicting a Santa Claus rally in the markets. He believes that the recent sell-off in the stock market is overdone and that the market is due for a rebound. Mannarino is recommending that investors prepare for a Santa Claus rally by buying stocks that are undervalued. He believes that this rally could start as early as 2 weeks' time and last through the end of the year. So, if you're looking to make some money in the stock market, you might want to listen to Mannarino and start buying stocks. From Mannarino's statement in the video, it's obvious he sees that this Santa Claus rally could be the start of a new bull market, a term used to describe a sustained period of rising stock prices. Therefore, investors should take Mannarino's advice and get ready for what he believes will be a substantial rally before the end of the year. Listen to these carefully.
So, with that said, let's cover some of this. More bad economic news, of course. So the ISM factory index has now officially, it's official, has fallen into contraction. You and I have known for I don't know how long that the economy, not just here in the United States, around the world, is contracting. If you were to look at global growth here as a percentage of GDP, it's in the toilet. It's got nowhere to go but much much further down that toilet. And this is being driven again by runaway central banks. And I think we're clear on that. So it's official. The factory index is now in contraction. Now, construction spending along with that continues to drop. Imagine my surprise here. Imagine your surprise. Continuing jobless claims now hit a 10-month high. And this is a very interesting piece of news. So Bank of America just came out with a report, according to their study, that beginning first quarter of next year, the United States economy will lose on average 175,000 jobs per month. I think that's probably a lowball number by a long shot. I'd be willing to bet we're going to lose closer to 400,000 to 500,000 per month starting next year. Look, we know for a fact corporate layoffs are on the rise. Thousands and thousands and tens of thousands of people are already losing their jobs. But again, you must be propagandized. You must be lied to.
Mannarino talked about the unemployment rate, which has been claimed to reach a 10-month high. He cites that the Bank of America predicts the United States economy will have an average of 175,000 jobs lost per month during quarter one of 2023. However, Mannarino claims that such statistics aren't possible, as he believes that it would be 400,000 to 500,000 job losses per month instead. According to a statistic report by Trading Economics, the U.S. unemployment rate stayed the same in November 2022 at 3.7%, staying in line with market forecasts and close to September's 29-month low of 3.5%. The report also revealed that since March, the unemployment rate has only fluctuated within a narrow range of 3.5% and 3.7%, indicating that the tight labor market will probably continue to put pressure on inflation in the United States for some time to come. Therefore, the United States unemployment rate has been forecasted to be 3.8% by the end of 2022 and is projected to trend around 4.4% in 2023. Listen to these carefully.
Bank of America also is warning, listen to this one here, with regard to inflation, they predict, according to their study, that inflation will run high for at least the next decade. So there goes transitory, there goes your temporary out the window. You and I knew this from day one. Now, this is something else that you and I have discussed many times here. It's very unfortunate, but it's starting to occur. We already understand that people have burned through their savings. People are now borrowing beyond their eyeballs just to make ends meet from their credit cards. Now, of course, if you would pay attention to Bloomberg, Fox Business, CNBC, they're telling you consumer spending is higher. But what they won't tell you is people have no choice. They have to spend more as inflation continues to rise. But, of course, this is being played up as like, oh, consumers are spending more. This is a great thing because they're so strong. But they've already burnt through all of their savings. Savings rate is in the negative. Banks are getting punished here, and you're going to pay for it. No savings, no loans, no deals. Remember, I've been telling you this. No savings, no loans, no deals. This is leading towards another bailout or a bail-in of the banks, the financial institutions, and you're going to pay for it. So anyway, what people are doing now, since they burned through their savings and they're already maxed out their credit limits, is now they're claiming hardship and tapping into their 401ks or whatever savings plans that they have. This is the final straw here. This is the final straw for those who are left floating aimlessly through the middle class. They're getting crushed, destroyed, wiped out, and exterminated, just as if they were insects. And this is, again, thanks to the Federal Reserve, central banks around the world who are going out of their way to do this now. There is an incredible situation going on. How many years have you seen me do this, okay? The stock market, the economy. As long as central banks, for as long as they can do this, keep rates suppressed, if they manage to keep the relative strength of the dollar low and crude oil propped up, where do you think stocks are going?
Inflation is on a high, and Bank of America is warning that the trend is unlikely to reverse anytime soon. According to the bank, inflation is expected to remain in the double digits for the next decade. This is due to a combination of factors, such as rising commodity prices, increased money supply, and an increase in demand for goods and services. The effects of inflation are being felt throughout the global economy, with prices rising on everything from food to energy. In the United States, the highest inflation rates are seen in housing and healthcare. The possibility of inflation remaining high for the next decade is real, and the central banks will be hard-pressed to contain it. Therefore, investors are advised to look for investments that are inflation-proof, such as commodities, real estate, and gold. It's also important to diversify your portfolio to avoid the risks associated with inflation. Individuals are also advised to save more and spend less in order to protect their savings from the effects of inflation. That's all for today. If you have any questions or contributions in regard to the topic being discussed in the video today, feel free to let us know in the comments section below. Kindly share this video with your family and friends, and don't forget to hit the like button and subscribe to our channel for more updates. Thanks for watching. Anticipate our next video update.